Hello everyone, this is Pineberry Mummy. Welcome back to my channel. Last week, Square announced purchasing this company called Afterpay using 1/3 of its market cap. That's a lot of money. Oh, actually, it's a lot of stocks because it's an equity-based deal. Afterpay, this company only generated about 4% of Square's revenue last year. That's why as soon as the announcement came out, a lot of people commented that Square has far overpaid for this deal. And some people also commented that Square could have built the feature by itself like what PayPal has done. However, if you look at this problem from a product management perspective or product strategy perspective, you should understand that product is not just a technical piece. If we see this from a business or commercial perspective, we would understand that with this deal, Square is going to have access to Afterpay's existing merchant relationship, which could take Square a long time to acquire by itself, and also Afterpay's existing customer base, and also Afterpay's existing overseas market share. And also this feature, this buy now, pay later feature, could supplement Square's current two ecosystems very well. So currently Square has the seller ecosystem and also Cash App ecosystem. This feature will supplement both very well. Let's see what our investment guru Chamath think about this deal.
The public capital markets will always reward great growth strategies. The minute that they announced this deal, the market cap of Square went up by almost 25%. The deal is free.
Free.
I repeat, they just acquired a $30 billion company for fucking free.
Which is what happened with Whole Foods and Amazon.
Here is the secret hiding in plain sight that not enough CEOs understand about the public markets. And so for the CEOs out there listening, there are two ways for you to get constantly rewarded by the public markets. Number one is what Square did, which is to incrementally acquire feature after feature after feature. The thing with buy now, pay later is that it is not a company. It has always been a feature. And it's a feature of a much larger financial services platform. And I think Square is proving that. And everybody else over time will realize it. Goldman Sachs and Apple are about to do something there with buy now, pay later as well for themselves. Apple already does it for the phones. So the idea is that this is just a credit feature that should be on every single major network. I wouldn't be surprised if WhatsApp and Facebook had a buy now, pay later feature.
Amazon.
Over time. Everybody needs to have this feature. You can't build a company around it. And so if Square can basically continue to acquire or build adjacent features that consolidates the financial services stack for their consumers, the stock market will reward these guys. They'll be able to grow and buy things for free for the next 5 or 10 years.
Great network effects. If you think about financial services for consumers, I would argue there's 5 general categories. There's banking, lending, trading, crypto, and insurance. And I think in order of retention, meaning how long a customer is likely to stick with a service provider, it's banking, then lending, then trading, then crypto, then insurance. And in terms of profit generation per customer per year, it's trading, then crypto, then lending, then insurance, and then banking. And so what we're seeing is a lot of these financial services providers to consumers in the digital world replacing the old school world by starting to consolidate these categories in a smarter way than the old school offline companies have been able to do. Banks need to make money through overdraft fees. They make $30 billion a year in overdraft fees. So if you make banking entirely online and make it free, you retain a customer and then you can make money by offering them lending, trading, crypto, some of these other services. And that's certainly the trend. I have a big thesis and a big belief that over the next decade, we're going to see those 5 categories start to merge, and you're going to have 3 to 5 superpowers that are going to offer a consolidated stack of services, and the unit economics are going to change because they're going to focus on getting the high retention products to be cheap and free, and then they're going to make money on the high margin products.
The canary, I completely agree with you, and the canary in the coal mine is who will be given a federal banking license, because that is the only gate that the authorities have to make who those consolidators will be. And that's an easy thing that can be unemotionally
Google
assessed.
Or Amazon just buy one of the banks out there?
No, you have to. This is an incredibly arduous process. to get a federal banking license, to be cleared by the Federal Reserve. I think Square now is a federally licensed bank, and I believe that that the Federal Reserve recognizes these guys. They can borrow money at the discount window at the discount rate. As startups get more successful and can get there, those will be the ones that will do what David said, because it doesn't matter how many users or how much momentum you have. If you cannot get a federal license to operate, you can't consolidate. So you can be a vertically specific great business, but eventually you have to sell. E-Trade, Morgan Stanley is a great example where, in the absence and an inability to expand, you have to sell yourself because the cost of capital eats you up. The comment on this, by the way, the most obvious one here, which I think is interesting, is the Shopify Stripe debate. Because if you look inside the P&L of Shopify, an enormous line item now, about $350 million a year is what they're paying to Stripe. And, there's going to be a lot of pressure over time to figure out what these big businesses want to do with respect to their payment strategies and do it themselves, because they may be able to save a lot of money. Unclear.
Based on what Chamath just said, he also gave $1 million investment advice.
If you just want to make a lot of money, and you have to have some financial stock ownership over the next few years, I think the way to do it is just to kind of figure out which of these emerging companies have or are about to get or have disclosed in their earnings that they're filing for licensure. And I think you want to own those things, because the key thing is, when you get these licenses, you just get a cheaper cost of capital. It just allows you to outcompete and outmaneuver.
I noticed that Chamath's company SoFi has a conditional approval of the banking license. This is for information only. Please don't treat it as my investment advice.
Then the policy decision becomes much more complicated, because I do agree with you that there's going to be platforming or deplatforming issues that happen. The good thing about this, that it is highly fragmented and that there is no clear path, at least that I see, for 2 or 3 folks to have 25 to 30 to 35% ownership. That already happened sort of in credit cards, and I think we've learned our lesson from that, and it hasn't happened since.
I hope it remains that decentralized, but what I think the reaction of the stock market to Square buying Afterpay is, now everyone's going to be looking at that and going, wait a second, I can spend, a quarter of the market cap of my company and have the acquisition be free?
But David, my point, that's not what they're saying. What they're saying is, hold on a second, these companies are features, and we want to have folks who are licensed and capable to consolidate what Friedberg said, these 5 categories. And if you look inside of Square, they have an incredible lending business. They have incredible merchant services business. They have a pretty decent and emerging crypto and trading business.
Right.
So they're putting all the pieces together. That's what they saw, and they're licensed.
It's actually quite interesting to compare what they mention as 5 categories with what we saw here in China and ASEAN. In China and ASEAN, the major fintech players focuses mainly on banking, lending, insurance, and some unit trust investment. And then there's another group of fintech players like Futu, Tiger. They focuses purely on the trading space. And maybe I shouldn't even call it as trading, because they're mainly like GUI providers and aggregators. They don't have the full end-to-end trading capabilities. And another group of fintech players, they focuses mainly in the crypto space, where they provide cash products and also derivative products, but they don't touch other asset classes. It would be quite exciting to see what will come next. Maybe there would be some consolidation in the ASEAN market too. After talking about all the bright sides of this deal, let's look at some of the potential risks. Some analysts is worried that with this feature, Square will be exposed to the credit risk from the retail customers. However, I think this risk can be mitigated by a proper product design. So you don't need to lift and drop what Afterpay has. Square can actually use the existing customers' banking balance and the investment portfolio as a collateral, and using that collateral to extract a credit line for the customer, or you can build a credit risk model out of it. I'm more concerned about the second risk, which is Jack Dorsey's value system, considering what he did last year before the election. Let's see what Zach said about it.
As an American, I'm definitely concerned about this accumulation of power. And we now see Jack as the first person. I don't think there's ever been anyone in American history who holds in his hands the right to deny people speech on a major speech platform and the ability to deny them access to a major consumer payments platform. Now, he doesn't have dominant market share in either one of those things.
He's got less than 10% in each.
But he's an influencer. And we saw that Twitter was the first site to kick off Trump. And then in the wake of that, every other tech platform did it. And Square, after January 6th, cut off the accounts of everybody who was involved or connected to it, whatever that means. And a bunch of other players in the fintech stack did it. So we now have this issue of financial deplatforming. PayPal is already well down that road. What will Jack Dorsey do?
So all the big fintech players they mentioned are centralized platforms. That's why you have the concern that there would be like a very powerful authority in the future which will cut off some people from like having access to financial tools. For me, like all this kind of fintech talk is more of putting old wine in the new bottle. It doesn't solve like some of the fundamental structure issues in the financial system. So if we think step further, like maybe the future doesn't belong to those giant fintech players. It actually belongs to blockchain and DeFi. It would be interesting to think. And do note, Jack Dorsey, the CEO of Square and also Twitter, is a strong believer, supporter, and executor in the crypto space. So I won't be surprised maybe he has already started thinking or even trialing in that direction. That's all for today. Thank you for watching. Please do hit the like button, subscribe, and share with your friends. Your support means a lot to me and it motivates me to produce better content.